Beijing lowered interest rates in an effort to spur growth after China's new zero-COVID plan and the collapse of the housing market shocked the industry. The problems in China will have a significant impact on global economic expansion. Hello guys, welcome back to the channel, and greetings. Today's video will discuss how China's entire economy has fallen, so stay focused. Winning approach breaks down. The Xi Jinping administration has reacted to the global COVID-19 pandemic by securing China's cities and meticulously tracking infections. The government's COVID-0 policy involves imposing widespread lockdowns on even small clusters, sometimes in cities with a population of 10 million. Although the strategy may have seemed overly strict to those in other places, it has established itself as China's winning strategy against COVID. This winning strategy was unable to stop the spread of infection after the highly contagious Omicron variant emerged in late 2021 and early 2022, and large clusters started to appear. Lockdowns were implemented in Xi'an at the end of 2021, Shenzhen, the Chinese Silicon Valley, in March, and Shanghai, China's largest business hub, in April. The negative effects of China's strict isolation policy were highlighted by these lockdowns. In Shanghai, there were more than 20,000 infections per day, and the 24 million residents were unable to go shopping for basic necessities due to lockdowns. The 2-month lockdown came to an end on June 1, but its effects were significant. A halt to economic activity. The lockdown brought Shanghai to a complete standstill, just as it had in Wuhan 2 years earlier. The Changjiang Delta, the center of China's economy, was rendered inoperable as a result of the widespread failure of expressways, container ports, and other distribution infrastructure. The impacts of the port closure trickled down the supply chain to the worldwide economy, since Shanghai, the largest container port in the world, acts as a sort of primary artery connecting the Chinese economy to the global economy. Japanese producers of automobiles, appliances, and electronics were compelled to cut back on operation hours or look for alternative suppliers as a result of delays in the supply of Chinese parts. In response to this situation, the Chinese government implemented a number of policies in April that aimed to speed up the supply chain and ease the movement of goods. One of these policies included the creation of a whitelist of 666 companies whose goods would be given preferential treatment, including automobiles, emergency aid, electronic parts, and everyday necessities. As a result, since May, factory output and shipment volumes have consistently increased, but the harm brought on by the lockdown was too great to be quickly repaired. The Chinese Statistics Agency said on July 17 that the GDP for the April-June 2022 quarter increased by just 0.4% in comparison to the same period in the previous year, a marked drop from the 4.8% growth seen in the January-March quarter. The whole East China region, which is the center of the country's economy, was impacted by the recession. Jiangsu and Zhejiang provinces experienced negative 1.1% growth and 0.1% growth, respectively, while Shanghai was particularly heavily impacted, plummeting 13.7% from the same time last year. In fact, all of China's main cities suffered severe damage. Beijing's capital also enacted strict COVID controls, though less severely than the lockdown in Shanghai, which led its GDP to contract by 2.9% from the previous year. Affected supply chain. Shanghai was under such a rigorous lockdown that those in other nations might well have thought it was bizarre. The COVID-19 pandemic's rise to such severity, however, may be attributed to the man-made process. Let's now examine how these incidents have impacted the world economy. According to how labor is distributed internationally, the effects of the lockdown on Chinese and foreign companies will vary according to the industry. Moving production overseas is no small feat for electronics manufacturers because, for example, China has a domestic industrial chain for parts and materials that is unparalleled anywhere else in the world in terms of scale and density. To maintain market share, local production of automobiles and other products for which China is a major market is necessary. Even while these industries did suffer severely as a result of the lockdown, the COVID-0 policy is not anticipated to result in any fast migration of production hubs to other countries due to the difficulty of doing so. However, firms have already started moving overseas in sectors where they are not required to be, based in China, and can do so if the conditions are right. For instance, final assembly of tech products, as a result of skyrocketing production costs, labor shortages, and a greater emphasis on economic security. The most recent string of occurrences is just another drawback of carrying on with operations in China for these sectors. In fact, there was a noticeable surge in foreign residents fleeing the nation when the lockdown was removed. The Chinese government continues to insist that its COVID-0 policy is still in effect, but given the high cost this time, it will work to prevent a replay of the current upheaval in the future. Despite the government's best efforts, any more outbreaks in those sectors where the presence in China is not required might push investor perceptions of the country's business climate too far in the wrong direction and hasten those companies' exits from the country. China's second problem. The decline in the property market that started in the latter half of last year has had a significant impact on China's economy as a whole, and was not the only factor contributing to the lockdown's impact on the Chinese economy in the June 2020 quarter. If the COVID-0 recession was an acute ailment in terms of human health, the problems with the real estate market are a chronic one. The Chinese government adopted an economic package in the June quarter that pulled out all the stops in terms of money and finance to recover from the severe economic downturn brought on by COVID-19. But this resulted in the summer's resurgence of the property bubble. The government then took action to drastically reduce credit to real estate developers out of concern. The entire real estate market experienced a recession in the second half of 2021 as a result of these policies, which were similarly overly strict as the Shanghai shutdown. Realizing the severity of the situation, the government started correcting the extremes of its economic tightening strategy at the end of last year. Presently, the government is making efforts to support the real estate market, such as by letting provincial governments to loosen the rules for home lending. The government's past overzealousness has left a dangerous legacy, though. Sales of residential property fell by 31.8% in value and 26.6% in floor area in the first half of 2022, compared to the same time in 2021. In terms of floor space, new development permits were down 35.4%, while land sales were down a startling 48.3%. As 1/4 of China's economic growth is reportedly attributed to the real estate industry, the impacts of the downturn are profound. Fearful fallout. The fact that the real estate downturn has had two detrimental knock-on effects makes the situation even more terrible. First off, it has considerably reduced the amount of money that provincial governments receive from land sales. Revenue from sales of public land, which makes up 30% of all revenue received by provincial governments, decreased by 31.4% in the first half of the year. This occurs at a time when these governments' revenues from value-added tax are drastically declining, but their spending on public works initiatives is increasing in an effort to support the economy. For the finances of the provincial government, this means crunch time. China's economy has to grow in the second half of 2022, therefore these financial issues at the province government level are very concerning. Where will it be in 2022's second half? The Chinese government's projected 5.5% economic growth target is suddenly becoming more and more unlikely to be met. But in the fall, the Communist Party's 20th National Congress will decide whether or not Xi Jinping will hold the position of leader for an unprecedented third term. Therefore, if at all feasible, Xi will try to prevent economic growth from slipping to a level of 2 or 3%. There is only monetary policy left. Whatever course Xi takes, he will not be able to have his cake and eat it too. As the Xi administration enters its third term, it faces a difficult road. That's all we have for you today. If you enjoyed this video, give it a thumbs up. If you don't want to miss any future videos, subscribe to the channel and switch on notifications. First and foremost, what do you think about why China's entire economy has fallen? Please participate and share your thoughts in the comments section below.